Come over to ZTRADEZ.net, check out our terms and conditions page if you agree to it. Continue to watch this video if you do not, as well as our disclaimer. Don't watch this video. Let's jump into it. How to enter a debit spread and why I would enter a debit spread. Now, using that as a strategy and turning stocks that are naked buys, they're just a straight up call or a put, turning that into a debit spread, when I would utilize debit spreads. I can kind of get into that a little bit. If you'd like to know that, you can sign up for the mentorship at ZTRADEZ, and you can join our free Discord below in the description, as well as our free newsletter to get weekly watch list on technical analysis and everything, and my views on the market, which is highly accurate. Let's just say we're going to use Webull as an example. The IV is high, very high, implied volatility, very high. So if the IV drops, meaning, you know, the stock's cooling off, people don't believe it's going to go up, they don't believe it's going to be volatile, even if the stock doesn't move, it stays. Where is it? Share price 12.90. This options contract could get cut by like 30 or 40 cents without the stock moving, not even close to expiration. If that happens, it's a new stock, IV is probably going to be high. I mean, look where Hood's at, right? And look at SoFi. SoFi's doing well. Hood is doing very well. Let's say I believed it was by July 18th. What is it right now? May 23rd? Let's say by July 18th, I believe that Webull was going to hit $17.50. This is where it comes in if you don't have a lot of money. You know, are you going to scalp on a $500 account and grow it as an amateur trader? You're not. It's very rare. If COVID happened, but then you just lose it again because you never learned how to trade. You're trading in an easy environment, which is why so many traders vanished after COVID. They just kept buying calls and didn't understand. So debit spreads are about capital preservation. That's number one. 2, about eliminating risk. 3, eliminating basically eliminating risk, all the factors that work against you. Imagine if we took, it was a Roman Colosseum. You had one guy. You know how they do these evil games. This is the best analogy I can come up with. Imagine you're a gladiator, and on the buy side, when I'm just simply buying a call, pretending that I think it's gonna go up by July 18th or even before there, and I believe it could go past 17.5, and I buy this call for $125. That's eating up a lot of the capital in the $500 account. How many things are against me? 1, direction. People think it's 50-50. Either it goes up or it's down. No. It goes up. It goes in your direction call, right, which is right. But what are the 2 risks? Flat. If it doesn't go up, that's a risk. It's not 50-50. In my opinion, all of them right off the bat have about a 20% chance of working, holding it long for a long period, 20% to 25%. Flat market. Wrong direction, it goes down. We're at 2 things. Okay. What else? Theta decay. Time. Right? High IV, meaning the IV can drop. I got to hold my hand correctly here so we can even see it with my cheesy camera. So 5 things, right? This implied volatility could drop. And even if the stock does move, it stays at 1282. The contracts are going to get cut by like 40 cents, 30 cents, and you can end up losing there. Now, imagine that Roman gladiator, you being you versus 5 people. The odds are against you, and this is what it's like on the buy side, on top of having a small account. So how can we preserve some of that capital and make it 1 versus 1? It's basically 1 versus 1.5. That's where debit spreads come in. How would I enter a debit spread? Horrible analogy. Bear with me here. How would I enter a debit spread? Okay, we're pretending I have $500. I would then sell a further out of the money call. Okay? We don't want to sell a closer to the money call. That would be than where you bought. So I bought this side. I always sell further out, meaning it's a buy side position. If I sold a closer in like this one, it's a sell side position, which means everything's opposite. That's another video. So I want to sell the further out. And that's the same. That is exactly the same if I were to believe that Webull was going to drop, right? I could be buying a put, and then I would sell a further out of the money put away from here. It's always the one further out. And I can go wider if I want. You really can't here because these aren't really worth anything, and the spreads are kind of bad. So May not be a good example. But anyways, let's go back to calls over here. We'll stick to the call side, 17.5. Now, how much capital is that going to take? 125 minus 90, which is 35 cents. So I've just preserved a lot of capital. I've erased, time really isn't that much of a factor anymore. It is, but it's not going to, you've eliminated a lot of that. Theta is not a factor. It is a tiny bit, just a tiny bit. Flat markets aren't a factor because if it runs flat, this is going to rot faster than this would, and you're going to get money back. This is profitable if we run flat. When we go down, this is profitable, but this is going to lose money faster than this will gain money because this is closer to the money. How do I make money doing it, right? If the stock goes up, this is going to lose value, right? This is going to be a loss to you. This will be a gain. So how do you make money? Well, this strike right here, this buy-side strike, is closer to 1282, right? 17.5 is closer to 12 than 20 is. So for every $2 you gain here, you may lose $1 here. Maybe every $3 you gain here, you lose $1 here, right? So you're hedged. You're hedged. So it's only 35 cents. And this is fantastic as a beginner. And excuse me for my horrible analogy. I should have thought of something a little bit better. This is fantastic for a beginner trader. Now you're only risking 35 cents, and you're not really risking all of it. You're risking about half of it, in my opinion, unless you're holding it unless Webull just absolutely dives and goes to like $7. Then that's going to be worth nothing. But then you only lost 35 cents, not 125. This is fantastic to learn. Small accounts should be utilizing debit spreads. New people should be utilizing debit spreads. You're eliminating so much risk, right? Who would you rather go if you were a gladiator in a coliseum? You verse 5 or you verse 2, right? We can kind of even the odds out a little bit. It'd be nice if it was 1 verse 1, but that's just buying the stock flat out. So now we're only risking 35 cents. Now we've also hindered the profit. We've hindered the profit a lot. Max profit is max loss 25. It's 25 to 35 here, but max loss is around 25 to 35 cents. Yeah, I think their calculations are a little bit off here. Max profit's 225. So you're risking basically $30 to make 225. Right? That's beautiful. Are you going to get the max profit? Maybe not. But would you get the max profit over here? Probably not. So we're only risking that much money, and our max profit's that. I really like those odds. Now, what if I wanted more risk, more reward? You've also hindered the upside because as it goes up, this is going to lose money. This will gain money. And again, this will gain money faster than this loses money. Okay? What if I was sure, but I didn't like the IV? Well, I could simply sell out of the money further. Let's say I sold this. Now I'm risking my max loss is, I feel like this is not calculating it properly here. My max loss is 50 to 70. I feel like this is not calculating because you can lose this right here. And my max gain is 700. So now I have more profit. I have more risk, but I also have more reward. I've doubled my risk, and my reward is more than doubled. My reward's almost, what is that? What was it, 225, 6? Yeah, I've doubled my risk, but I've tripled my reward. So if I'm wrong, I have to be okay with basically losing that, right around that. And again, I think that Robinhood's calculations are a little bit off, but that's around what it is in between here, 50, 75. You're risking 50 to make 700, right? Now, you could say that over here, hey, I'm risking 125 to make unlimited. That's unless you're really sure. So the wider you go, the more risk you open yourself up to. Let's go ahead and pull up a different stock. Let's pull up NVIDIA, right? Because look how expensive. Let's pull up Tesla. Look, this is wrong stock. This is where it really comes in, guys. When you have a small account and you don't want to do something like Webull, you want to do something like Tesla. Let's say we go out to July 18th, and you believe it's going to go up by that. Let's say they had an event for their Optimus robot or their robo-taxi or something, or something new, the Tesla phone to compete with Apple, right? But it's going to be in all Tesla cars and Apple tanks because they're removing Apple products and the plugins out of the Apple car for the Tesla phone. And it's July 18th. Well, if I believe it's going to hit, I don't know, 400 by then, that's $1,500. If I have a $500 account, how am I supposed to do that? I can't really do that, can I? You don't have the money. What if you only had $500? Again, then I can sell a 410. It's only going to cost me $210 instead of $1,500. Look how much capital you preserved. And when it drops, again, if you're wrong, this is not going to get hit as hard as if you were just in a naked buy. This could get hit like $700 like that. Look, we just dropped right now on Tesla pre-market from $346 to $330, $10 drop. So if you're naked on this, there's $700, poof, gone like that. Now, if I'm in a debit spread, right, I just made money over here, and this 210 may have dropped to 170. You know, not a big deal, 40 cents. I kind of like that better. New people, utilize debit spreads. Please utilize debit spreads. And the way you grow a small account, in my opinion, is swing trading, learning some simple technical analysis, not all the jargon on a 5-minute. That's for pros. You basically have to be almost a pro, an advanced intermediate to intermediate trader to be day trading on Robinhood and grow $500. You're not going to do it, guys. I'm going to say that. The people that tell you can, usually they're con men and they want you to sign up for their group or their course. That's just what it is. I've been around a lot of traders, and a lot of them are just straight up con men. Salesmen, right? Anyways, and again, I'm risking around $193 to make 807. The wider I go, let's go out to 425. Now my max loss is 430. I can gain 2,000. I can just keep going further out of the money. Max profits 4,000. My max risk is 728. Let's bring this down. Let's say I were to go $5 out of the money. I'm risking $100 to gain 400, 4 to 1. I kind of like that. It would really have to go a lot past 405 though. But you have the option to have your hand in Tesla for July 18th for $100. You can still play it for that long. What if I wanted to go out to, what if I wanted to be in all year and I had a small account and I'm positive it's going to hit, $450. Let's just pretend. Okay, that's $3,800 and you don't have $3,800. Well, then I could sell that. For $235, I can be in the whole year. $235. I could even go out further. It would cost me $1,000 instead of $3,000 or whatever it was. $3,800, almost $4,000. It cost me $900. Max profit $4,000. Again, I can play with this like this and preserve my capital. So again, we reduce risk, all the factors that are against you, and we preserve our capital. And when we're wrong, it's hedged. What people will do when they want to, okay, I think I'm in a leap, but I think it's going to go down. Then they come over and then they buy a freaking put, another buy side position. And they're like, let me go over here and hedge. Now you're like 8 G's deep and both sides are rotting and losing value. No. That's not how you do it. If you are really, really up on Tesla and then you bought a put, let's say I was up like $10,000 and then I bought a $4,000 put. That's a little bit different, but both sides are rotting. That's not helping you, right? That's why we would come back over here. And if I were to be up a lot, then I can sell a call and that would be my hedge. Let's say, okay. Now, this is supposed to be for the mentoring, but I'll give you guys a little hint in how and when I do that. But let's say Tesla shot up to 450, and this thing's worth $10,000. Okay? This cost me right here $3,800. I can come up, and we'll pretend that the $500 calls now are $5,000. Then I can sell that there. I cannot lose. I've received back $5,000. And I only put $3,800 in. Worst case, I make 30. What's the difference between 38 and 5,000, right? It's around 1,200. Worst case. And I have no risk. I've eliminated all of it. So there's ways to utilize debit spreads, and there's some more advanced strategies. It goes way deeper than that. But again, preserve capital, reduce risk. When you're wrong, you're hedged. And you're hedged without having both sides rot by buying a put. You do not hedge by buying another option so that you're opening yourself up to more theta decay. The guy that's writing those options is making a killing off you of all that decay he's collecting. If you guys like this information, make sure to like and follow for more. Join the free newsletter, join the Discord in the description of this video. I hope this video helped.